Every major financial crisis in American history destroyed the wealth of millions, but not everyone lost. A small group of people, not the richest, not the most connected, simply knew which assets behave differently when the system comes under pressure. They moved early, they moved quietly, and when the crisis peaked, their wealth was intact while everyone else was calculating their losses. Right now, in 2026, the U.S. banking system is showing stress signals that mirror 3 previous crisis periods simultaneously. Commercial real estate is collapsing. Regional banks are bleeding deposits. Consumer credit defaults are climbing past 2008 levels. The conditions are not coming. They are already here. And the question is no longer whether your savings are at risk. The question is whether you understand which assets have protected wealth through every single crisis this country has faced, and what is fundamentally different about 2026 that changes the calculation. Here's what you need to understand. 5 assets have a documented track record of holding or gaining value when the U.S. financial system fractures. Today we break down all 5, what the historical pattern shows, what the current data signals, and what is different this time that most analysts are completely missing. To understand why these 5 assets matter right now, you need to understand the pattern first. The United States has experienced 4 major financial crises in the last 100 years: the Great Depression of 1929, the stagflation crisis of the 1970s, the savings and loan collapse of the late 1980s, and the global financial crisis of 2008. Every single one was different in its trigger. Every single one was identical in its structure. Credit expanded beyond sustainable levels. Asset prices inflated beyond real value. A catalyst exposed the gap between price and reality. Confidence collapsed. Wealth transferred, from those who held the wrong assets to those who held the right ones. That transfer is not accidental, it is mechanical. It happens the same way every time because human behavior under financial stress follows predictable patterns. Institutions sell what they must. Individuals panic. Governments intervene late. And 5 specific asset classes absorb the capital that flees everything else. But here's the context that makes 2026 structurally different from every prior crisis. In 1929, the dollar was backed by gold. In 1970, America still dominated global manufacturing. In 2008, the Federal Reserve had unlimited room to cut rates to zero and deploy quantitative easing without inflation consequences. None of those conditions exist today. The Fed is constrained, the dollar is being challenged, and an active geopolitical conflict involving Iran is injecting an energy shock variable that none of the previous 4 crises had to absorb simultaneously. This is where it gets serious. The 5 assets still work, but the order of priority has shifted. And missing that shift is exactly what will separate protected wealth from destroyed wealth in 2026. Here is exactly what history shows, and what 2026 is doing to each asset. Asset 1. Gold. In every single U.S. financial crisis on record, gold either held its value or increased significantly. During the 2008 collapse, gold rose over 25% while the S&P 500 dropped 38%. During the 1970s stagflation, gold increased over 1,700% across the decade. The pattern is consistent and mechanical. When confidence in paper currency and banking institutions fractures, capital moves into the one asset that carries no counterparty risk. In 2026, gold is already responding. Prices crossed $3,000 per ounce earlier this year, a level that historically signals institutional hedging, not retail speculation. Central banks across Asia and the Middle East are buying gold at the fastest rate in 50 years. That is not coincidence. That is positioning. Asset 2. U.S. Treasury bills, short duration only. This requires precision. Long-duration Treasury bonds get destroyed in high-inflation environments, but short-duration Treasury bills, 3-month to 12-month maturities, have preserved capital in every crisis period because they reprice quickly with interest rate changes and carry the full backing of the U.S. government. In 2026, with banking stress accelerating, Treasury bills are absorbing significant deposit migration from vulnerable regional banks. That flow is already happening, quietly, at scale. But this is where the story changes. Asset 3. Cash and money market funds. Most people dismiss cash as a crisis asset. That is a mistake. In the immediate phase of every financial crisis, before asset prices bottom, before policy response kicks in, cash is the highest performing asset simply because everything else is falling. Liquidity is power when credit freezes. But here is where 2026 creates a specific risk that previous crises did not. If banking stress escalates to the point where money market funds face redemption pressure, as nearly happened in 2008 before emergency government intervention, cash parked in the wrong institution carries real short-term disruption risk, even if it remains technically insured. Asset 4. Commodities, specifically oil and agricultural goods. Every crisis involving geopolitical instability has driven commodity prices higher. The 1973 oil embargo, the Gulf War price spike, the 2008 commodity supercycle. The pattern is clear. When supply chains face disruption and currency confidence weakens simultaneously, hard commodities absorb capital rapidly. In 2026, the Iran conflict variable makes this asset category uniquely urgent. Roughly 20% of global oil supply passes through the Strait of Hormuz. Any escalation that threatens that choke point does not just raise gas prices, it triggers a cascading inflation shock across food production, manufacturing, and transportation simultaneously. Asset 5. Swiss franc and select strong foreign currencies. This one surprises most people, but history is unambiguous. When the US dollar comes under pressure during domestic financial stress, capital rotates into currencies backed by fiscally conservative governments with low debt ratios and stable banking systems. The Swiss franc has appreciated against the dollar during every major US financial crisis since 1970. In 2026, with de-dollarization accelerating globally and the BRICS bloc actively building dollar alternative settlement systems, the Swiss franc play carries additional structural support beyond just the domestic crisis dynamic. 5 assets, all with documented crisis track records, all currently showing activation signals simultaneously. That has never happened before. Here is what makes 2026 categorically different from every prior crisis period. In every previous US financial crisis, these 5 assets did not activate simultaneously. They activated in sequence. Gold moved first, then treasuries, then commodities, then currency rotation. The sequencing gave informed investors time to position gradually as the crisis developed and signals clarified. That sequencing is gone in 2026. All 5 assets are showing activation signals at the same time. Gold above $3,000, treasury bill demand surging, money market inflows accelerating, oil prices structurally elevated by geopolitical risk, the Swiss franc quietly strengthening against the dollar. When all 5 move together, it means institutional capital, the money that moves markets, not retail sentiment, has already made its assessment. The crisis is not approaching. It has been priced in at the institutional level. What hasn't been priced in yet is the retail and middle-class response. That gap, between institutional positioning and public awareness, is the strategic window. But here is the structural shift that changes the priority order of these 5 assets in ways that previous crisis playbooks do not account for. The Iran conflict has introduced an energy variable that directly impacts 3 of the 5 assets simultaneously. Oil and commodities activate immediately on any Strait of Hormuz escalation. Gold accelerates further as a geopolitical safe haven on top of its financial crisis role. And the dollar weakens faster than historical crisis models predict because geopolitical stress compounds the existing domestic banking pressure. This means in 2026, the traditional crisis asset hierarchy, gold first, treasuries second, cash third, needs to be reweighted. Commodities, specifically oil-linked assets, move to a higher urgency position than in any previous US financial crisis. Not because the historical pattern changed, because an external variable, the Iran conflict, is applying pressure to the same system from a completely different direction simultaneously. 2 fracture points, 1 financial system, 5 assets absorbing the pressure. The window between institutional positioning and public response is measured in weeks, not months. Here is what sophisticated money managers are actually thinking right now, and why their logic matters to your personal financial decisions. The framework being used inside major institutional investment desks in 2026 is not the standard crisis playbook. It is a hybrid model that combines 2 historically separate analytical frameworks, domestic financial stress modeling and geopolitical risk pricing, into a single unified assessment. That combination has never been formally required before. In 2008, geopolitical risk was a background variable. The crisis was purely domestic: bad mortgage assets, over-leveraged banks, frozen credit markets. Geopolitical factors barely registered in the asset allocation decisions being made at the time. In 2026, geopolitical risk is not background. It is a primary driver running parallel to the domestic banking stress. And the institutional response to that dual pressure reveals something critically important about which of the 5 assets carries the most asymmetric upside right now. Gold is being treated institutionally not just as a financial crisis hedge, but as a geopolitical crisis hedge simultaneously. That dual role means demand pressure on gold in 2026 is structurally larger than in any previous crisis period. 2 entirely separate categories of institutional buyers are competing for the same asset at the same time. Central banks hedging dollar exposure and portfolio managers hedging domestic banking risk, both reaching for gold simultaneously. This is why gold above $3,000 is not the ceiling in the current environment. It is the floor from which the next move is being calculated. Treasury bills tell a different analytical story. The institutional logic here is not about return, it is about counterparty elimination. When banking stress reaches the level currently being observed in regional institutions, sophisticated capital does not just want yield, it wants zero counterparty risk. A 3-month Treasury bill held directly through Treasury Direct eliminates bank intermediary risk entirely. That counterparty elimination premium is being priced into short-duration Treasury demand right now in ways that yield numbers alone do not fully capture. The commodity analysis is where institutional thinking diverges most sharply from mainstream financial media coverage. Most financial commentary treats oil price risk as an inflation problem. Institutions are treating it as a currency problem. Here is the distinction that matters. If the Iran conflict escalates to the point of meaningful Strait of Hormuz disruption, the oil price spike that follows does not just raise consumer costs, it accelerates the timeline of dollar stress by forcing larger U.S. trade deficits, increasing import costs across every dollar-denominated supply chain, and compressing corporate margins in ways that feed back into banking system stress through deteriorating commercial loan quality. Oil is not just an energy asset in this environment, it is a dollar stress amplifier. And that amplification effect connects directly back to gold, Swiss franc positioning, and the overall urgency of the 5-asset framework in 2026. Most people are missing this connection entirely. They are analyzing each asset in isolation. Gold, treasuries, cash, commodities, currencies. 5 separate decisions, 5 separate analyses. The institutional framework treats all 5 as a single interconnected system responding to a single underlying pressure, the simultaneous fracturing of domestic financial stability and global dollar confidence. When you understand the system, the individual asset decisions become significantly clearer. But the other side tells a different story, and it deserves to be heard with full seriousness, because the opposing case is not made by optimists or uninformed commentators. It is made by credible, data-driven analysts who have been right before. Their core argument is this: the 5-asset crisis framework is being dramatically over-applied to a situation that does not yet meet the threshold of a genuine systemic crisis. What 2026 is experiencing, they argue, is a controlled stress cycle, painful, disruptive, but fundamentally contained within the boundaries that post-2008 regulatory architecture was specifically designed to manage. Their first point is capital strength. The largest U.S. financial institutions, the ones that carry genuine systemic weight, entered 2026 with Tier 1 capital ratios significantly above regulatory minimums. The stress is concentrated in regional and mid-size institutions, not in the systemically important banks whose failure would constitute a true crisis. A regional bank problem, they argue, is not a banking crisis. It is a banking correction. Their second point challenges the gold narrative directly. Gold above $3,000, they argue, is not a crisis signal. It is a speculation signal. Retail and institutional momentum chasing driven by fear-based media coverage and social media amplification. They point to 2011, when gold peaked above $1,900 during the European debt crisis, was widely described as the beginning of a permanent safe haven supercycle, and then proceeded to collapse 45% over the following 4 years as the crisis narrative faded without systemic collapse materializing. The pattern of buying crisis assets at peak fear, they argue, has destroyed more middle-class wealth than the crises themselves. Their third point addresses the Iran conflict variable directly. Every Middle East conflict since 1973 has triggered oil price spike predictions that financial markets ultimately absorbed without the catastrophic cascading consequences that analysts predicted. The Strait of Hormuz has been threatened rhetorically dozens of times across 5 decades. It has never been successfully closed. The institutional infrastructure, U.S. naval presence, alternative routing, strategic petroleum reserves, specifically exist to prevent the doomsday oil scenario from materializing. Crying wolf on Hormuz, they argue, is a recurring feature of geopolitical risk analysis, not a reliable crisis signal. Their fourth and most uncomfortable point targets the personal finance framing of crisis asset advice directly. When financial commentary tells middle-class viewers to move savings into gold, Swiss francs, and commodity-linked assets, it is, intentionally or not, encouraging ordinary people to take on significant volatility, currency, and liquidity risk with money they cannot afford to lose. The same people who cannot absorb a 45% gold correction. The same people who do not have the holding period required for commodity cycles to resolve favorably. Crisis asset positioning, they argue, is a strategy built for institutional patience and capital depth. Applied to personal savings without those conditions, it carries its own category of serious risk. These are not weak arguments. They are structurally sound, historically grounded, and worth sitting with seriously before acting on any of the analysis presented in this video. Here is where the opposing narrative has its own critical gap, however. It assumes the containment holds. It assumes no confidence-breaking public failure occurs before quiet resolution mechanisms can function. It assumes the Iran variable stays rhetorical rather than kinetic. Each of those assumptions is reasonable individually. The problem is that all three must hold simultaneously for the benign scenario to materialize. In complex systems under multiple simultaneous pressure points, the probability that every assumption holds is not the product of individual probabilities, it is significantly lower. That is the risk the opposing view has not fully priced. Here is where the analysis stops being theoretical and starts hitting your actual daily life, specifically and directly. Most financial coverage explains crisis assets in abstract terms. Portfolio allocation, macroeconomic hedging, institutional rebalancing. Language built for people managing tens of millions of dollars, not for someone trying to protect $15,000 in a savings account or $60,000 in a retirement fund. So let's be precise about what each of these 5 assets actually means for a real person in 2026. Gold, what it means for you personally. You do not need to buy gold bars. Physical gold storage carries insurance costs, security risk, and liquidity friction that eliminate most of its crisis benefit for ordinary savers. What history shows works for individuals is allocated gold exposure through established ETFs, specifically those holding physical gold directly, not derivatives. The cost of entry is a single share. The liquidity is identical to a stock. The crisis protection track record is identical to physical gold. For someone with $10,000 to protect, a 10 to 15% allocation to a physical gold ETF has historically been sufficient to meaningfully offset losses in other asset categories during crisis periods. The direct personal impact of not holding any gold exposure in the current environment is this. If banking stress escalates and the dollar weakens simultaneously, which the current data suggests is the base case trajectory, your savings account balance stays nominally the same while its real purchasing power declines. You do not feel the loss as a number going down. You feel it as groceries costing more, rent increasing, and your salary buying progressively less. That is the stealth wealth destruction that gold historically interrupts. U.S. Treasury bills, what it means for you personally. This is the most immediately actionable of the 5 assets for ordinary savers. TreasuryDirect.gov allows any U.S. resident to purchase Treasury bills directly from the federal government with as little as $100. No broker, no intermediary, no bank counterparty risk. Current 3-month Treasury bill yields are meaningfully above most high-yield savings account rates. You are getting paid more to eliminate bank risk than to accept it. That is an unusual condition that directly benefits individual savers right now, not institutional investors. You. The personal impact of ignoring this is straightforward. Every dollar sitting in a regional bank savings account earning 0.5% annual interest, while that bank faces undisclosed balance sheet stress, is simultaneously earning below-inflation returns and carrying unnecessary counterparty risk. Moving a portion of savings to direct Treasury bills eliminates one risk and improves return at the same time. Cash and money market funds. What it means for you personally. The practical personal finance implication of the cash analysis is not about holding more cash indefinitely. It is about knowing where your cash is held right now. A money market fund at a systemically important institution, not a vulnerable regional bank, carries meaningfully lower disruption risk during a banking stress event than a standard savings account at a mid-size regional institution. The FDIC insures up to $250,000, but insurance does not eliminate the disruption window. For a small business owner or freelancer operating on thin monthly cash flow margins, even a 5-day account access disruption during a bank resolution process can be operationally catastrophic. Know where your cash is, move it if necessary. Before the event, not during it. Commodities. What it means for you personally. The Iran conflict oil variable has a direct personal economic consequence that requires no investment decision at all. It is already hitting you. Gas prices in 2026 are structurally elevated above pre-conflict levels. Food prices, directly linked to agricultural commodity costs and transportation fuel expenses, are compressing household budgets across every income bracket. This is not an investment consideration. It is an immediate cost of living reality. The investment angle for individuals is this. Commodity-linked assets in a diversified portfolio have historically offset the purchasing power erosion caused by commodity price spikes. You pay more at the pump. But a measured allocation to energy-linked assets means a portion of that price increase flows back into your portfolio, rather than purely out of your wallet. The practical entry point for individuals is broad commodity ETFs, not individual oil futures contracts, which carry complexity and risk inappropriate for personal savings. A 5 to 10% allocation to a diversified commodity ETF has historically provided meaningful inflation protection without the volatility concentration of single commodity exposure. Swiss franc, what it means for you personally. This is the most overlooked of the 5 assets for individual savers, and potentially the most important in the specific 2026 context. Currency diversification is not a concept most ordinary Americans have ever considered. The implicit assumption is that dollars are dollars, stable, reliable, universally sufficient. That assumption has been correct for most of the post-World War II period. It is being stress-tested in 2026 in ways it has not been tested since the 1970s. The practical personal finance implication is not about converting your entire savings to Swiss francs. It is about holding a measured portion, 5 to 10%, of liquid savings in a strong foreign currency as dollar devaluation insurance. Several established financial platforms now allow individual U.S. residents to hold foreign currency accounts or currency-hedged ETFs without requiring international banking relationships. The barrier to entry is lower than most people assume. The direct personal consequence of holding zero currency diversification if the dollar weakens significantly in 2026 is this. Every dollar of savings, every dollar of future income, every dollar of retirement value declines in real global purchasing power simultaneously. There is no offset, no natural hedge, pure exposure to a single currency in a period of documented dollar stress. Now pull back and look at all 5 together from a personal finance perspective. The combined picture is not about getting rich from a crisis. It is about not getting quietly poorer while the crisis runs its course. The middle-class wealth destruction in every previous U.S. financial crisis did not happen through dramatic single events that people could see and respond to. It happened through the slow, invisible erosion of purchasing power, savings value, and financial optionality, while people waited for an all-clear signal that arrived years too late to matter. What this means for you is specific and immediate. You do not need to act on all 5 assets today. You need to understand which of your current financial positions carry unexamined risk and make 1 or 2 deliberate adjustments before the acknowledgement phase of this crisis arrives publicly. Because once it arrives publicly, the window closes, the assets move, the prices reset, and the protection that was available quietly at current levels becomes significantly more expensive or unavailable entirely. So here's exactly where this goes. Let's be precise and honest. Short term, next 30 to 60 days, gold holds above $3,000 and makes another leg higher, not because of retail speculation, because central bank buying from China, India, and Middle Eastern sovereign wealth funds does not stop at round numbers. The institutional bid underneath gold in 2026 is structurally larger than any previous crisis period. A move toward $3,200 to $3,400 in the next 60 days is the base case, not the optimistic scenario. Treasury bill demand continues accelerating as deposit migration from regional banks intensifies. The spread between what vulnerable regional banks offer on savings accounts and what direct Treasury bills yield widens further. More ordinary savers discover Treasury Direct. The flow becomes self-reinforcing. Oil prices remain structurally elevated with significant upside volatility risk tied directly to Iran conflict developments. Any single escalation event, a naval incident in the Gulf, an Iranian proxy attack on Gulf state infrastructure, or a breakdown in back-channel diplomatic communication, triggers an immediate oil price spike with direct gasoline and food price consequences hitting American households within days, not weeks, days. The Swiss franc continues its quiet appreciation against the dollar. No dramatic move, no headline moment, just steady, consistent strengthening that most Americans will not notice until they check the exchange rate and realize their dollar buys meaningfully less than it did 6 months ago. Midterm, next 3 to 6 months. This is where the scenarios diverge most sharply, and where your decisions in the next 30 days determine which scenario affects you most directly. Scenario 1. Controlled stress resolution. The Federal Reserve executes a carefully timed rate cut cycle that relieves enough balance sheet pressure on regional banks to prevent a high-visibility public failure. The FDIC quietly arranges 2 or 3 weekend acquisitions of the most vulnerable institutions before depositor awareness reaches panic threshold. The Iran conflict stays below the kinetic escalation line, elevated tension, elevated oil prices, but no Strait of Hormuz closure event. In this scenario, gold consolidates between $3,000 and $3,200, not collapsing, but not making dramatic new highs either. Treasury bills remain the rational cash alternative. Commodities stay elevated but stable. The Swiss franc holds its gains without dramatic further appreciation. The crisis narrative fades slowly. Financial media declares a soft landing. Most people breathe relief and return their attention elsewhere. But here is what the controlled resolution scenario does not fix. The underlying structural damage, the commercial real estate losses sitting on bank balance sheets, the consumer credit deterioration, the long-term dollar confidence erosion, does not disappear because the acute phase was managed. It gets absorbed slowly over years through inflation, credit tightening, and gradual purchasing power erosion. The middle class pays for the resolution through a decade of compressed financial optionality rather than a single dramatic crisis moment. The 5 assets still protect you in this scenario, just more quietly and over a longer time frame. Scenario 2. Cascading public failure. One mid-size institution fails publicly and visibly before a quiet resolution can be arranged. A single weekend acquisition falls through. Depositors at similar institutions see the headline and begin moving money, not in panic, but in rational self-interest, faster than the system can absorb. Simultaneously, an Iran conflict escalation event pushes oil above $120 per barrel. Gasoline prices spike to levels that trigger immediate, measurable consumer spending contraction. Inflation reaccelerates just as the Federal Reserve was preparing to cut rates. The Fed is now caught between 2 simultaneous crises, pulling policy in opposite directions. Cutting rates to relieve banking stress reignites inflation. Holding rates to control inflation accelerates banking deterioration. There is no policy response that addresses both simultaneously. In this scenario, gold moves rapidly toward $3,500 and beyond. Treasury bills become the primary safe harbor for capital fleeing both bank risk and equity market volatility. Commodities spike sharply before demand destruction eventually caps the move. The Swiss franc appreciates dramatically against the dollar, and the 3 assets most people held, standard savings accounts, stock market index funds, and real estate in stressed commercial markets, all face simultaneous pressure from different directions. This is not a prediction that scenario 2 is inevitable. It is a precise mapping of the escalation path that current conditions make structurally possible in ways that no previous U.S. financial crisis period has combined. The honest probability assessment. Scenario 1, controlled resolution, remains the more likely outcome. Institutional frameworks, regulatory mechanisms, and the political imperative to avoid visible crisis during an election-sensitive period all bias toward containment. But the margin between Scenario 1 and Scenario 2 is narrower in 2026 than at any point since 2008. And the Iran variable, entirely outside the control of U.S. financial regulators, means the probability of Scenario 2 is not determined purely by domestic policy competence. It is partially determined by decisions being made in Tehran, in Gulf state capitals, and in U.S. naval command centers in the Persian Gulf. That external dependency on the crisis outcome is genuinely new. And it is what makes the 5-asset framework not just relevant in 2026, but urgent in a way that no previous version of this analysis has required. The final reality. The financial system will absorb 2026. It always has. It always will. The United States has survived every crisis on this list and emerged with its fundamental economic architecture intact each time. But survival at the system level and protection at the individual level are 2 completely different outcomes that require 2 completely different responses. The system surviving does not mean your savings survive intact. It does not mean your purchasing power is preserved. It does not mean the decade following this stress cycle feels prosperous or expansive for middle-class American households. History is unambiguous on this point. The people who protected their wealth through every U.S. financial crisis were not smarter than everyone else. They were not richer. They were not better connected. They simply understood which 5 assets behave differently when the system comes under pressure. And they acted on that understanding before the public acknowledgement phase arrived. That window is open right now. How long it stays open is the only thing nobody can predict with certainty. If this analysis gave you clarity that mainstream financial coverage is not providing, share it with someone who needs it. Because the people around you are making financial decisions right now without this information. And in 2026, that gap in awareness is measured in real money.